Guys, today I want to show you how you can prevent high impermanent loss in your liquidity pools. We're just going to sit back, have a chill conversation. I'm going to try to give you guys as much value as possible. I want to dive right in today. So a couple things that I want to talk about. First of all is obviously that this works, and I want to show you the proof, basically. So I have an Ethereum to TAL liquidity pool right here. Deployed $29,903. Currently I have $21,685. So down about $220 from prices going down. But I have earnings. Helps outweigh that asset depreciation. But point is, on those earnings, I am profiting basically 100% compared to holding in the market. And over here on sold to render, same exact thing. This time not 100%, but pretty damn close. I currently have $19,140 of total value. That includes all my unclaimed earnings, 1.3K basically. My deposits were $21,000. So I'm down about 2K overall. But point is, of that 1.32K, I have a 1.28K profit compared to holding the market. I am profiting compared to holding the market at nearly a 100% rate of my earnings. Now, if you guys are kind of confused what impermanent loss, divergence loss is, long story short, it's opportunity cost compared to holding the market. And basically with this versus hodl or compared to hodl, this can be negative or this can be positive. If it's negative, that means you would have been better holding the market and not doing liquidity pools, right? You would have had more money that way. Or if it's positive, that means you have more money in your liquidity pool strategy. And just another thing is the maximum versus hodl that you can have is the total of your earnings of, in this case scenario, 314. Anyways, how do we do it? Let's get to the sauce basically. So how we do it is we analyze before we invest. Most people are diving into crypto to stable liquidity pools. They'll blab about how they earn 200, 300% APR. Hey, some even say they earn 10% per month off like Wrap Bitcoin USDC, Ethereum USDC. Truth be told, they don't. They earn like 30 to 50% per year. And they also get completely wrecked by holding in the market. It would have been better for them to hold Bitcoin or for them to hold Bitcoin and USDC in the market, basically. So what do we focus on? Crypto to crypto liquidity pools, because those two things both move. When one's going up, we're under the expectation that the other is also going to go up. And that's why we look for highly correlated cryptocurrency assets. This currently has an 87% correlation right here, which essentially means that these assets move at a very, very similar pace. If one's going up, the other one's most likely going up. If one's going down, the other one's most likely going down as well, which already off the bat helps mitigate a lot of our divergence loss. Once again, we need earnings as well, because the more earnings we have, the more buffer room we have, right? Because we can have a ton of divergence loss, and I mean a ton. But if our earnings outweigh it all, basically, and we have plenty of earnings to outweigh it all, we have substantially more earnings, then of course that ton of divergence loss does not matter because we have so much, in earnings basically. Now, another thing that we do is we backtest things before we actually dive in. We stress test them. We're like, okay, what happens if TAL goes down 9% and Ethereum does nothing? Well, we'll have $350 of opportunity cost. In that case scenario, we only need 6 days of earnings to outweigh that. And we know that it's highly unlikely that TAL is going to go down 10% and Ethereum is going to stay the same. It's more likely that TAL will go down 10% and maybe Ethereum will go down 3.7%. And in that case scenario, we only have $140 of divergence loss, in which we only need roughly 3 days of earnings to outweigh basically. So if you look very, very closely at this on Metrics Finance, you can see it says your position needs to be active for greater than 2.35 days to cover opportunity cost, which is divergence loss and permanent loss. Same exact thing, guys. So by back testing before we invest, that's also another crucial step. So we've already identified 3 different things. Number 1, crypto to crypto. That's your best bet. Number 2, high correlation. Higher the correlation, typically the lower the divergence loss you're going to have. And number 3, back testing things before we start investing into them. Seeing how long it actually takes to outweigh divergence loss. Seeing what type of divergence we could see if one asset kind of differentiates itself from the other. So those are 3 golden rules right there. And before I get into the next one, guys, if you're looking for support in your DeFi portfolio because maybe it isn't performing the best right now, because truth be told, a lot of people's portfolios are bleeding. We've turned around over 200. We've helped deployed over $50 million in the past 2 years in business. There's going to be a link right below to our website to check it out, see more about our strategy. And then from there, if you're interested, you can hop on the phone with one of my team members, see if it's a good fit for us, but also see if it's a good fit for you, and we'll go from there. Anyways, the next one, the most important one, is rebalancing, right? Most people are waiting until they get out of range till they rebalance, and I'm here to tell you that that is not what you should be doing. As you can see, this is my range right here. I'm not going to wait until I am out of range to rebalance. I am going to rebalance when I am at a good period in time, closest to my entry price. The reason why is because at my entry price, we will have $0 in divergence loss, $0 in opportunity cost, $0 in permanent loss, right? $0. And that's because that's right back where we have our initial asset ratios. You know, I have no divergence loss right now in this pool because I started with 70% and I now have 71%. This has bounced around, but it's ultimately came back down to where I'm currently at, basically. So the best time to rebalance is at your initial entry price. So if we're rebalancing out of range, we're getting further and further and further away from our initial entry price, locking in worse rebalances. So what do I do here? Right? Well, when we look at this chart, you could see prices slowly moving up. We're getting further and further and further away from our initial entry price, which means that we're having more and more and more divergence loss. But the thing is, I wait for it to come back closer to my initial entry price. Now, I should probably be rebalancing for the simple reason of, well, I was close to going out of range over here. I'm not going out of range towards the bottom half of my range, so I should move this range, adjust it accordingly, and allow a little bit more upside exposure. Bring that top line up a bit so that way we don't go out of range in the future. So we're preventing future divergence loss or slowing down that future divergence loss by adjusting that range. And again, there's a lot of strategies where you can kind of minimize the amount of divergence loss you have, or maybe you inject new capital instead of executing trades, and then you really don't have any divergence loss. There's examples where you can just barely rebalance, right? And when I say barely rebalance, I mean if you are out of range, just slightly adjust the range so you slightly get back in range and start earning fees and just barely lock in any divergence loss. Those are all strategies that you can do, but why not stop while you're ahead, basically, and analyze everything before you get into the pool? And then, of course, when it does come to your rebalances, implement those along with this rebalance strategy that I'm telling you right here. That is the best way to do it, and that is the best way to avoid high impermanent loss and sometimes even all impermanent loss in your liquidity pools. Over here, we take a look at my other Ethereum to TAL liquidity pools. This one had a $675 profit compared to holding the market and $1,051 in earnings. Let's take a look at what that range looked like. You can see we went all the way over here, right? We went down and we kind of idled over here. And keep in mind, this pool was open for about a month. And then all of a sudden we start to creep back up. So what do? I rebalance. And since I rebalanced, it was actually a good rebalance because I prevented future divergence loss. We would have been out of range by now. I also have this other one over here that had $225 in earnings, $130 profit versus HODL. We take a look, it's going to be a very, very similar thing. You can see we started to creep up. I'm like, okay, well, number one, this range is way too wide. We need to tighten it up a little bit because I was getting a 55% APR. But number two, right, I was following the trend when I rebalanced. Some of the Ethereum to Aether pools that I used to run back in the day, $8,600, nearly $8,700 in earnings, and I had a $4,750 profit versus HODL, right? Some of these pools I did get a little wrecked on, like this one over here. I still profited versus HODLing in the market, but I had $2,000 in earnings nearly, $37 profit versus HODL. That one kind of did me a little dirty. I wasn't really paying attention to it, and you can see I ended up actually rebalancing when I was out of range. Realistically, my best time to rebalance, my indication to rebalance should have been after I went out of range over here. Most likely when I came back in range, this would have been where I would have rebalanced if I was paying attention. This would have been the best area to rebalance when we were at a price of like 54,500 or so. So point is, rebalance closer and closer to your entry price to get that divergence loss down, but also at the same exact time, make sure the pool just makes sense, because not every pool makes sense. A lot of people will struggle to see that. A lot of people will just see the APRs. A lot of people will just be like, oh, this asset, I like this asset, I'm going to go dive in. But sometimes, well, number one, the yield is just too low to outweigh any divergence loss. Even if the divergence loss is low in the first place, the yield just might be way lower. But other times, right, the divergence loss is just so high that the yield is not going to outweigh it, even if the yield is super high, basically. So sometimes they do not go together, right? Oil and water. What we want is water and water, or oil and oil, basically. We want them to mix. We want them to essentially have an even balance. So that's exactly why we simulate things beforehand. Hey, if we were to dive into Ethereum to USDC right now, let's just look at it. Well, right now, if Ethereum's at 1817, what happens if Ethereum goes to $2,000? Well, look, we need 8.3 days to cover that. And that's Ethereum going up 10%. It could go up 10% in 2 days. That's not bad. What happens if it goes to $2,200? We need 35 days to cover that, right? So it's going up 21%. We need 35 days to cover that opportunity cost. It's going to be very hard to do that in a pool like this because we're in Ethereum to USDC. Guys, if you found some value in this video, you guys want more content like this, feel free to let me know down below in the comment section what type of videos you guys want to see in the channel. Also drop a like, subscribe, notifications turned on, and of course, if you need support with your portfolio, you know where to go. See you guys in the next one. Peace out.